Hello, welcome, and this is another video. We proceeding with these videos on smart money concept, and this is another video that is going to elaborate a lot of secrets, especially in the forex market. Okay, so today let's look at what we call order blocks. Okay, so what are order blocks? These are the candles where the market makers or banks have placed their positions. Okay. So generally, the market returns to those candles and they are never violated, okay, if they are real order blocks. Okay, so those are the points, those are the areas, those are the candles where we believe they will never be violated, okay, if they are real order blocks. So we have two types of order blocks. I'm going to show you with the charts in few seconds. We have two types of order blocks. The first type is what we call bullish order block, and this is what the second we call it bearish order block. So bullish stands for bulls, that is buying, that is going long. Okay, so when we go long, we go bullish. When we go short, we go bearish. Okay, so this is how we have. So bull is from an animal, a bull that always fights going upward, okay? And this bearish is an animal too. It always fights standing then coming down. That's why we say when you talk about bullish, you're talking about buying. When we talk about bearish, you're talking about uh, selling. So what is bullish order block? Be very careful at this point, okay? Because don't just look at what you see here, because I want to elaborate more apart from what you are seeing from the slide, okay? Bullish order block, this is the last bearish candle. It is not necessarily a bearish candle. It can be a bullish candle, okay? Before the bullish movement. So it can be a bullish or a bearish candle before a bullish movement. This bullish movement must have very, very high momentum. Do you understand? So it is not just any bullish movement. Okay? Just understand this. This is going to help you a lot. Okay? But also it must break the market structure. Okay? So we have two criteria here, very, very fast. First of all, it can be a bearish or a bullish candle before high momentum bullish movement. And that movement must break structure. That means we must have what we call break of structure or the break of market structure. That is BMS. So I'm going to show you in very simple steps. For example, here you have a bullish movement, okay? Let's take this is the bearish or a bullish candle before very, very strong bullish movement. So let's take an example. This one is the bullish movement. Let me show you some lines here. Let me show you some lines here. So you can look at this, look at this, look at this. This is, let's take, this is our movement, okay? This is our upward movement after forming this, what we call a bearish candle here. And that is where we had our, what we call our bullish order block. So it is just a candle. Remember that. So an order block is just a candle that you draw it. But here you can see in this way, they have demonstrated it that just you take it from the lowest point, and then you take at this point here the entry point, but you can draw to the high here because you have a low and you have a high here if this is the bullish candle. Okay, that is very important. So what we have to do is to make sure we draw the whole candle. Okay, don't just draw from the open point to the low or from the closing point to the high. Okay, just draw the whole candle, the whole candle, the whole candle. Let me show you here. Of course, sometimes because of the risk, this is just for risk matters. Okay, for risk matters. Sometimes you can find when you draw the whole candle, you find your stop loss is very, very big, especially those guys with small counts. So at the end of the day, you have to reduce by just coming down here to draw in what we call an opening price here, okay, as you can see. But if it is not, it is having a low risk, then you can just draw the whole candle like this. Let me show you from here to the top to this point here. This is only when you don't see that when you draw this way at the end of the day, because if you draw at this point, the stop loss must be there. That means the stop loss pips are increasing. When they go out of your risk management, that means you cannot take that trade. But if you find maybe to the point here where the market is opening, the candle is opening, because this is bearish candle at this point here. When you have this kind of order block, if you find it is respecting your trading plan, then you can just enter at this point. But if it is not, just enter here above. Enter here above. Okay. This is very important. Okay. This will help you to make sure you maximize your profit. You make sure you're not missing some trades, but also to make sure you are in line with your trading plan. This is an example you can see here. The most lower candle here is the bearish candle. You can see very high momentum here. Price was going up, and you can see we had to draw. You can see here we have to draw the whole candle here. Okay, the whole candle, the whole body from high to low. Okay, and then you could see the price came down. This is what you call mitigation. When the price comes down, it always comes down to mitigate. Okay, I think someone is getting me, right? Someone is catching me right now. I think someone is catching me right now. Okay, so we have another type of order block. This is bearish order block. This is the last bullish or bearish. Okay, remember that before very high momentum movement, which is bearish movement. I will show you some structures, some markets, some charts, which you can think like they are correct, but they are not correct. Don't just draw your order blocks somehow so that you can be in, so that you can trade. Okay, we have some rules I have shown here. Okay, we had this very, very strong momentum. Then we had this BMS. This is lack of market structure. Okay, but here you can see we had some high momentum. That's why we had some fair value gap, some imbalances here. This is what confirmed this entry. Let me show you here some mistakes people make. Okay, I'll show you very soon. The same concept. Bearish order block is when you have a bearish movement and then you are looking for the bearish order block, as you can see here. So you must have high momentum that will break a structure here below and then wait for mitigation. Look at this point. Look at this. Look at this. You can see here we have this very, very clear entry point. For example, at this point, this was the mistake. I want to show you something you can understand. Here we could do like this. We could draw like this. Let me show you. Because what we are looking, it is the last candle that made inefficiency or imbalance. That is the fair value gap. Okay, you can see this one. The last bullish candle here, that the 4-hour bullish candle here had some mistakes here. Why? Because you can see the next candle, okay, didn't form what we call imbalance, a fair value gap. Okay, but the second one, which is a lead one, you can see it created a candle which formed what we call imbalance, and this imbalance is here, you see. So when you have this kind of imbalance, then the above candle can be used at the order block. This is the new concept, right? But this is the best. So I could draw this way here. Instead of drawing this one, I could just use this one because this candle is very large. If I draw it this way, you can see it is taking a lot of pips. Sometimes I don't take this kind of pips because let me tell you, this is 4 hours. Remember, this is more than 100 pips. Okay. So we don't trade those kind of trades. I always take some trades which are sniper. At the same time, those trades with very low risk. Okay, when I make money, I will make. Okay, when I lose a little. Do you understand? That is how you can be profitable. If you don't use that concept, you can end up being a loser in this market. Okay, let me show you how I could draw this one. So I had to draw this way. First of all, let me use this one in order for the protection of the stop loss. I could come down to this. Okay. Why? Because I wanted to minimize. It is not a problem. If I miss this kind of trade, there is no any problem. But you can see the stop loss is just at the same point. What I did here is to minimize risky. Instead of coming to draw from this low here, from raw, this bearish candle, I had to draw to this closing point here. Some people are not aware of closing. Let me show you. For example, this is the bearish candle, okay? Let me show you. You can see the market opened, this candle opened here. It went up, okay? Then it went down here, coming down here, then it came back here. So this point is where the market opened. This candle started movement was created. This is where this market closed, and therefore you can use this closing price here as the point of entry, as I've shown you there. Why to minimize trade? Because most of people could just take this trade. For example, they could say, okay, I'll take let's take our this is our take profit, okay? This is our take profit. If this is our take profit and you find this kind of trade, my friend, what are you doing here? Because you can find it is almost 1:1 risky to reward ratio. So what you have to do is to make sure you minimize. That is stop loss. One of the way to minimize is this way, okay? Then you could enter there. Very, very simple, my friends. Very, very simple. Very easy, right? Very easy. Very, very easy. So let's go to another point here. I'm showing you. Okay, this is one of the demonstration. This is the opening price O, then C, that is closing price that I was showing you there. Okay, then we have high and we have low. Okay, so this is what I have demonstrated there above. Daily range price action. This is what we call, this is type of price action that you have to know, the daily range. This is defined as opening price, low of the day, high of the day, and close price. So we have high of the day at the highest point here. We have low of the day at the lowest point here. Then we have close price and opening price. This is opening price. If opening price is below, is down, that means this is the bullish candle. But if opening price is above, that means it is a bearish candle. So let me show you. This is a bullish day. This is a bearish day. Why? Because of the positions of closing and opening prices. Okay. So we always use these concepts when you're trading. Let's go and see. Well, how do we use these concepts? I will show you the next video on how we use this concept, especially when you're trading. Remember, Forex is not about setups. Some people are making mistakes. It is about price and time. When you're just using some market structures with no respect to time, you can end up losing. That's why you have to use what we call price time theory. That is what I'm going to teach you in the next video. If you're new here, make sure you subscribe to this YouTube channel, because you're getting these concepts for free, and some guys are selling these concepts. So make sure you subscribe, you like, and comment. Look at the link there for the best broker you can use to trade, but also join my Telegram group free. Have a nice day.